right, welcome back, and let's begin our viewer queries section now. And before we speak to our viewers or get their questions on board, let's flash our WhatsApp number and email ID that you can note down and send across your financial portfolio queries. The WhatsApp number is 86579745571, and the email ID is the moneyshow@etnow.tv. All right, so I'm joined by Gautam Kalia. And Gautam, let's begin. Let's take Pramod's question. And he says that he's from Kerala, 36 years old, investing 53,000 per month in mutual funds. He's got Tata Digital Fund, Quant Infra, Quant Health, HDFC Banking, Finance, Quant Flexicap, Navi US, and Tata Smallcap, Small Smallcap, Motilal Oswal Midcap, Parag Parikh Flexicap. And he also has a stock portfolio. And so he's planning to invest for at least 14 years. He wants to know if there is a need to reshuffle or revamp his mutual fund portfolio. Are there any funds that he should plan for an exit strategy from, or reinvest that particular money in any other asset class or any other fund? Gautam.
Yes, Kavita. So, Pramod, if you're watching, then 53,000 per month. If you continue for the next 14 years, that's great. If that grows at 12%, you're looking to create a corpus of 2.3 crores. And when I look at your funds, before I get into funds, you also mentioned you got about 39 stocks. So I would say that you please look to actively manage that yourself or look for advice there as well. When I look at your funds, I see a little bit extra exposure, additional exposure in the thematic and sectoral place. So I would suggest that you reduce that and come into a more conventional portfolio. So and large cap allocation, dedicated large cap allocation seems to be missing in your entire portfolio. So I would say HDFC Banking and Financial Fund, Quant Health, Quant Infra, and Tata Digital Fund. These places you need to reduce by half and move that money into SIP in HDFC Top 100 Fund. So that's a good large cap fund. So effectively, you're looking at about 12,000 rupees a month going into HDFC Top 100. You need to reduce Tata Digital by 5, Quant Infra by 2,000, Quant Health by 2,000, and HDFC Banking by 3,000. So that reduction you do to make this change. Otherwise, the other schemes and the allocation seems fine.
All right, so that's a solution for Pramod. Okay, let's move on, and let's take Ramanathan question. And he says that he has about 100 odd mutual fund schemes, and 12 to 15 fund houses are a part of his portfolio. That's a lot. And initially the investment, I think he started from 1,000 rupees to 5,000. He's retired now and just over 60. Portfolio has large cap, mid cap, small cap, flexi cap, Nifty 50, multi asset. He's got money market, banking, PSU and corporate bond, dynamic bond fund, equity and debt, gold, pharma, credit risk. I think he's covered it all. Okay, so the question over here is what kind of change would you recommend having this kind of an over diversified portfolio? And since he's retired, we really don't have the clarity of what's the purpose of this portfolio, but he says that he can continue investing for more 2 years. And I think he's finally realized that the number of mutual funds are a lot in his portfolio, so he also wants to know the exit strategy from which funds. And he's got SWP done on few funds as well of 10,000 rupees. All right, so what is going to be the roadmap? He's not shared his funds names, but I think he's got all of that covered. So considering or assuming that we know what are there in those 100 schemes, which ones he should be sticking on with, Gautam?
Yeah, so first, on a lighter note, I'd like to say I'm so glad he didn't send me the list of 100 schemes because that would have taken about an hour or
I
two
think
for
my
me to
producer also would say
review.
that, yeah.
but we see this a lot. Unfortunately, what happens is it's a very gradual development where you keep investing in some NFO. Over time you invest with different advisors, and then you suddenly end up with a very complicated portfolio. If you don't prune the hedges, then they'll become like this. The portfolio will become like this. So you have to make sure, you have to be very disciplined in terms of allocation. You need to make sure that you have about 10 to 15% allocation in a scheme. That way you're invested in a portfolio of 6, 7 schemes. That way you are extremely clear on the quality of the scheme that you're investing in and whether it has a place in your portfolio. So it's a meaningful allocation rather than investing like this, because then it just becomes extremely difficult to track and assess. So, we look at performance attribution. If your portfolio has gone up by 10%, do you really know which are the schemes that actually contributed most to that 10%? And with a 100 scheme portfolio, it becomes extremely difficult to figure that out. So what I would say is that with someone of Ramanathan's age and stage in life, I would say please reduce the number of schemes. Obviously, build a standard portfolio. I keep offering new investors a standard portfolio. Going for something like that with a slight large cap bias. And for someone like you who's retired and who's not looking to invest anymore after the next 2 years, then I would say look at a combination of debt and equity. Even look at hybrid funds, aggressive hybrid, if you have the risk appetite for it. And obviously start looking at the portfolio from an income generation perspective, because you're probably looking at the portfolio to start giving you some money back. So start maybe an SWP of 4 to 7%, depending on what rate you're comfortable with, by investing in, let's say, an aggressive hybrid scheme like an ICICI Prudential Balance Advantage Fund or a HDFC Balance Advantage Fund. So those are the, I would say, guidelines that you need to follow to kind of transition your portfolio, because obviously there'll be taxation and maybe exit load implications in your portfolio, which I can't comment on.
All right, we don't have him on the phone line, but then I hope all the things in the portfolio are covered. But then let's move on and let's take Vignesh's question. He sent his portfolio details. He's got a couple of funds. Okay, the current portfolio is 2.20 lakh. That's what he says. He wants to invest for 17 years, and corpus should be around 3 CR from this particular investment and portfolio. Got it.
Yeah, so Vignesh, fantastic. You have a 17-year investment time horizon. You just have to stay the path, stay the course, and don't get distracted on your journey. It's a long journey. So 24,000 rupees a month growing at 12% will not be enough for you to reach 3 crores, but you could increase your SIP amount by 10% every year, and that would help you reach about 2.9 crores, which is nearly there. So that's one suggestion that I can make. The other is maybe look to increase your overall SIP amount if you can. So 24, if it becomes 45,000 from today, you'll get there. But if not, then just try to increase it as much as you can on a yearly basis. If I look at your current portfolio and the funds that you've invested in, this is different for me, because now I'm telling someone to actually add small cap in their portfolio. So you don't have a dedicated small cap exposure. So what I would say is reduce your allocation to DSP Nifty Next 50 by 1,500. So instead of putting 5,000, put in 3,500 there, and reduce your allocation to Edelweiss Flexi Cap by 500 rupees. So that 1,500 and 500, 2,000 rupees you put in HSBC Small Cap. That way you have an allocation to small cap fund as well, and that will round out your portfolio.
All right, I think with that, it's time up on the show today. Thank you so much, Gautam, for being a part of this show and helping our viewers with their financial portfolio queries. And for the viewers, I'm going to leave you with our WhatsApp number and email ID. So do send across your questions in case you want to get your live financial planning done on the show. Thank you so much for watching. Goodbye.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.